Joining me today is Rob Turnham. Rob is the President and Chief Operating Officer for Goodrich Petroleum. Rob, good to see you today. You and I have spoken a few times over the years. No doubt a lot has changed since then, but we're also looking forward to getting back together and seeing you at Haynesville and Shreveport this October. But for now, we wanted to talk to you about the Haynesville. You're, I believe, 100% nat gas weighted in the Haynesville. Did you expect really that there would be a time as soon as right now to be in that position and that would be a great place to be?
Sure, Jessica, and thanks for having me. Congrats on doing this. I think it's great for industry and great for the investment community.
Thank you.
You know, we've been public for 25 years. We've seen many cycles, both for oil and for gas. Certainly gas has been out of favor for quite some time. But just like in '08, when we were an early mover in the Haynesville, we always believed in natural gas, obviously a cleaner burning fuel. It's always going to be a part of the demand stack, and it's nice to see, obviously prices improving into the future. What's really remarkable, however, is how productive the Haynesville has evolved into over the last, call it 6 years. We went from producing about 1.1 BCF per thousand feet to over 2.5 BCF per thousand, mainly through completion methodology changes and optimization, and obviously drilling longer laterals. So we've always believed in natural gas. We probably didn't see the extent of the productivity from the Marcellus and the Haynesville. And we clearly didn't see the amount of associated gas coming out of the Permian. And not that we wish ill will on any of our company and our friends in the oilier basins, but the fact that we've had much less crude oil coming out of that basin in particular, and the forecast for much reduced capital expenditure budgets certainly bodes well for natural gas. And then, of course, you have to bake in what the others are doing in the Haynesville and the Marcellus as well. Just reduced CapEx budgets is going to create certainly less supply. And then on the demand side, we need to get to the other side of the virus, recapture some of the lost demand that we've seen from economy shrinking, but feels like we're heading in that direction. So hopefully, as we exit this year, we're going to be in a much tighter supply and demand environment. We certainly believe that.
And Rob, speaking on forecasts and looking ahead, nat gas is poised for a great winter, 2020 into 2021. Estimates are that supply will fall to 84 BCF a day, while February demand usually is higher than that. And that we might exit winter maybe 500 BCF in storage. As far as predictions, what's your outlook there?
Really can't argue with any of those numbers. If you look at the gassy basins, you look at the capital that's being spent in both of the Marcellus and the Haynesville, hard for us to imagine much growth, if any, if not supply declines. And then more importantly, tell me where oil prices are going, and I'll give you a confident estimate. As long as oil prices are range bound where we see right now, clearly you're not going to see the associated gas that we've seen before. Combine that with much lower budgets and a rig count. Who would have thought the rig count would be near 300, down dramatically? And you know what? In our industry, you don't just flip a switch and start drilling again. There's always a lag time. There's a lag time on a supply response. We think you're going to continue to see supply fall to hit those numbers that you quoted. And then once you start to see better pricing, there's a lag on bringing rigs back in, drilling those wells, organizing your budget such that you can complete them in a timely manner. So there's usually a 6-month lag on a supply response or price response as well. So we see a promising 2021, probably starts sooner than the end of the year, assuming we get a normal summer weather pattern and we start to see a normal winter season developing. So we'll see where it goes, but it certainly feels a lot better than it has any time over the last 5 or 6 years.
And Rob, the Haynesville itself is particularly poised for a nice winter because of proximity. Can you talk a little bit about how that would work?
Well, there's a demand pull from the Gulf Coast, as everyone knows. It's not just LNG export facilities. It's petrochemical, it's other manufacturing industries that primarily burn natural gas to produce whatever the end product is. So clearly, close proximity means you pay less transportation to get it there. There's more pipes being in planning stage and being developed to take gas directly from the Haynesville to these demand sources. So that's clearly a positive. We think basis probably tightens in the future because of that. And we still have preferential pricing, as you know, Jessica, just being where we are. So it's well situated. We have a very friendly government that doesn't tax the production until the earlier of payout or 2 years, so no severance taxes. Very productive wells and low lifting costs, which is generating really good rates of return. So it's strategically, we're in a great place, and we think natural gas is going to have its footing. And ironically, even at call it 275 gas, those rates of return, because service costs have been impacted from the lower activity levels, we can generate much higher rates of return at 275, even 250 gas, than back in phase one of the Haynesville when we were in a $8, $9, as high as $12 gas environment. So our business is a margin business. How productive are your wells? What's the revenue? What's your lifting costs? How expensive is it to get it to the market? And we've just never seen as good of returns as we're seeing now, as long as prices materialize like we think.
And how does the economics of the Haynesville compare to other oil and gas basins?
Well, pretty remarkable when you bake in our current supply costs. And by the way, I mean, pretty amazing what has happened on frac costs in particular. At the peak in the Haynesville, we were probably spending $110,000 per stage to frac our wells, and we're now below $30,000 per stage. It's really remarkable when you consider that the stimulation is probably 60% or the completion side is probably 2/3, and stimulation is 60% of your completion costs. Then the dollars saved on stimulation really drives your economics. And so to be able to generate north of 100% rates of return at 250 to 275 gas is pretty remarkable. And so again, back to my comment earlier, this is a margin business. We don't need extremely high gas prices. When you get extremely high gas prices, service costs tend to follow, and your margins can shrink. So we're seeing a point, as long as oil prices stay reasonable, we see where we could generate the best returns of any basin, much less, not just the gassy basins, just due to the productivity of these wells.
And Rob, some LNG tankers are being loaded on the Gulf Coast. We see with 4 orders as their next destination. How will the expected decline in LNG shipments drag down the fullest potential of a rise in nat gas prices this winter, or will it?
I think the winter, potentially could be fine. It's current that it's really dragging down prices. I mean, we've gone from, we probably lost 4.5, 5 BCF a day short term of LNG export demand. So that's impacting our prompt months as supply demand gets tighter anyway. So I think, we've got to get to the other side of the virus. We've got to get worldwide economies back to where they were, certainly close to where we were. Under that scenario, LNG is going to do very well. We'll see prices rise for LNG. But in the meantime, we have this bubble where we've got too much world supply, primarily due to demand destruction from COVID-19. So I think, as long as we get therapeutic drugs or a vaccine in a reasonable amount of time, we see demand snapping back. You've certainly seen a lot of stimulus from governments worldwide to try to help create some stimulus for their economies. And I think once the economies pick back up, LNG will pick back up. That's less supply on the domestic market here. Prices should rise again as long as we have reasonable weather and and demand because of that. And we know supply is coming down. So feels like it's setting itself up right now, but we are in a period where we need to get to the other side of this virus caused depression on the demand side.
And of course, looking even further into the future, asking you to see the future, what about more of an LNG outlook going into next year? Do you have anything to add there?
It has to get better. I mean, you would think.
Yeah.
You know, so much of what's been done in the past, they had contracts that were tied to liquids. You're seeing more and more contracts tied to JKM or a European index or something that's really tied to more gas prices. And so, again, as demand improves, LNG, as GDPs come back to where they were, or certainly close to where they were, demand will come back for LNG. Mexican exports will get back to where they were. You know, gas produced domestically that goes away from us will improve again, and we're already seeing gas, as expected, take share from coal, hold its own on all the other sources. So I think I think it's coming. Next year ought to be a better year across the board. Probably going to be better for oil also. The question is just at what price do all the Permian guys in particular start spending more money, growing oil supply, how much associated gas from that oil supply hits the market, and where is demand. But when you look at everything, and you're right, no one has a crystal ball, but when you look at everything that's lining up, certainly 2021 ought to be productive and good for both oil and gas, we think. Certainly better for gas until oil prices recover.
And I think, Rob, you've really kind of transitioned into my final question for you on a path forward from here. You know, being a leader in our industry, do you have words for the industry on, you know, moving forward? But also, do you have any thoughts on what the industry will look like? Some say, you know, maybe getting smaller, or just there's a lot of thoughts, I guess, going forward.
I think getting smaller is likely. What we've been fueled with is a lot of private equity investment over the last 5 to 7 years or so. I think a lot of the smaller firms that were set up with overhead money, no assets, go find something, put it together and sell it to others. I think that model is busted, probably stays broken for a while. And therefore you have, fewer players in the business. You also have, obviously, as everyone knows, a tighter equity market. Debt markets aren't great unless you're a really large company, almost investment grade, to get really low cost of capital. Banks are more conservative, due to sensitivity to price decks. And so I think all of those things, along with where we sit right now, is going to cause companies to spend less money, which means less supply growth, which means better economics. And then on top of that, you combine that with the new thesis, which is don't just grow for growth's sake. Spend money wisely, return capital to shareholders, whether it's paying down debt or paying dividends or being prudent with your money. And I think that continues because the investment community wants it to continue. So I think, the fossil fuels aren't going anywhere anytime soon. Prudent use of capital will always have a place in our industry, but you're just going to be penalized and not have access to capital if all you're doing is trying to create something and outspending in order to grow. It's got to be prudent business decisions on a return-based focus.
Rob, we really appreciate your time that you give to Hart Energy, and thank you for spending this time with me for your insight. We definitely look forward to seeing you in Shreveport in October. Again, thank you very much and be safe.
Thank you, Jessica. Always good to see you. Take care.
Thank you.
For more Hart Energy videos, follow our social media channels.